Once upon a time, owning a home in California was the dream. But in 2025, it is the insurance premiums, not the mortgage, that are breaking families. From the wildfire-prone hills of Malibu to the floodplains of Sacramento, homeowners are being hit with annual premiums of $7,000, $10,000, even $15,000. And in many cases, insurance companies are pulling out entirely, leaving residents with no coverage at all. Today, we revealed the top 10 California cities where insurance costs are destroying homeownership. If you think your mortgage is high, wait until you see what people are paying just to protect their homes. Subscribe to Discover the Nation for hard-hitting housing investigations you will not find anywhere else. Let us begin.
Number 10, Santa Clarita. Santa Clarita, one of Southern California's fastest-growing cities, has always been known for family living, good schools, and quiet canyons north of Los Angeles. But in 2025, that suburban dream is being tested. The insurance crisis that has swept across the state has found a new epicenter here in the foothills. Average homeowners' insurance premiums in Santa Clarita now exceed $8,000 a year, and for many families, even that does not guarantee coverage. Major insurers have withdrawn from high-risk neighborhoods near Canyon Country, Stevenson Ranch, and Saugus. Thousands of residents have been forced onto California's FAIR Plan, a last resort policy that offers limited protection at a steep cost. The reason is clear. Years of relentless wildfire seasons have reshaped how insurers view this city. Brush fires driven by Santa Ana winds have repeatedly scorched the edges of neighborhoods once considered safe. Even homes built with metal roofs, cleared vegetation, and updated fireproofing measures are still classified as high risk simply because of geography. For middle-class homeowners and retirees, the math no longer works. Some are selling after decades of stability, unable to manage another renewal. Others are choosing to go without coverage at all, gambling that the next spark will not reach their street. The irony is painful. Santa Clarita's hills still glow gold at sunset. Families still walk Main Street in Old Town Newhall, and the city still feels like the promise of California life. But beneath the calm lies growing fear, the fear that one insurance bill can undo everything a family has built. If you want to understand how climate and economics are changing what it means to own a home in America, subscribe to Discover the Nation. Santa Clarita's story is more than a warning about fire. It is a reminder that even the safest suburbs are not safe from the cost of risk.
Number 9. San Diego. For decades, San Diego represented everything people loved about California: sunshine, safety, and the promise of prosperity. From the cliffs of La Jolla to the beaches of Coronado, it was a place where families dreamed of planting roots, and retirees envisioned peace by the sea. But in 2025, that image is cracking. The city once defined by ocean views and optimism is now struggling under the crushing weight of an insurance crisis unlike anything it has seen before. Homeowners across San Diego County are facing record-breaking premiums, with the average annual cost now exceeding $9,000. In some coastal communities, policies reach $15,000 or more. Major insurers, wary of wildfire risk in the inland hills and flood exposure along the Pacific, are pulling out one by one. Even homes built to the highest safety standards are being denied renewals or hit with rate increases that make coverage nearly impossible to afford. The state-managed FAIR Plan, meant as a last resort, has become the only option for thousands. But this plan provides limited coverage and comes at a steep price, excluding essentials such as theft and liability protection. For families in areas such as Poway, Santee, and Escondido, who already face rising property taxes and stagnant wages, this added burden is pushing budgets past the breaking point. Developers are feeling the strain as well. New home construction has slowed dramatically. Buyers hesitate to sign contracts without affordable insurance, and lenders are rejecting loans in high-risk areas. The ripple effect is spreading as property values soften and small landlords are forced to raise rents or sell properties altogether. For the middle class, this is more than a financial issue. It is a question of whether the California dream still exists. Families who spent decades building their lives in San Diego are now being priced out, not by the cost of buying a home, but by the cost of protecting it. The city that once embodied the promise of California now stands as the symbol of its affordability crisis.
Number 8. Sacramento. Sacramento was once California's great compromise. It was more affordable than San Francisco, more livable than Los Angeles, and close enough to both to feel connected to the heart of the state. But in 2025, that balance has shifted. The city's housing affordability is now being drowned by insurance costs, new flood maps, and rising property taxes. Located at the meeting point of two major rivers, Sacramento has always lived with the risk of flooding. But recent FEMA flood zone updates have redrawn the city's boundaries, placing thousands of additional homes in high-risk classifications. That means mandatory flood insurance even for neighborhoods that have never seen water on their streets. Premiums have surged to record levels. Many homeowners now pay more than $7,500 each year in combined insurance costs. Families in South Natomas, Pocket Greenhaven, and along the American River are among the hardest hit. Their total cost of homeownership has climbed by thousands of dollars annually, even before considering mortgage payments or utilities. Developers are holding off on new construction, buyers are waiting on the sidelines, and longtime residents are feeling the squeeze as property taxes rise alongside insurance renewals. The city once promoted itself as the affordable alternative to the Bay Area. Now, for many families, it feels just as costly, only without the high-paying jobs that made those prices bearable. The flood walls that surround Sacramento still stand firm, but the financial pressure is rising higher than the rivers ever could. The city that once promised safety and stability is discovering how fragile both have become. Sacramento still shines with its beauty and charm. The tree-lined streets, the Capitol skyline, and the calm rhythm of life remain. But beneath that surface, the growing costs are slowly washing away the dream that once defined this city. If you want to see how climate risk and financial reform are reshaping America's housing future, subscribe to Discover the Nation. Sacramento's story is not just about water. It is about how even the most stable communities can be swept away by economic tides.
Number 7. Monterey County. Monterey County has always been one of California's crown jewels, a breathtaking stretch of coastline where the Pacific meets rugged cliffs, rolling vineyards, and timeless charm. From the cypress-lined shores of Carmel to the farmlands of Salinas, this region once embodied a perfect balance between nature and prosperity. But in 2025, that balance is collapsing under the weight of an insurance crisis, redefining what it means to live along California's coast. Homeowners across Monterey County now face staggering insurance premiums, averaging over $11,000 a year, with some coastal zones exceeding $15,000. The reason is simple. Insurers no longer want the risk. Between wildfire threats in the inland hills and rising sea levels along the coast, major carriers have withdrawn or reduced coverage across the region. What remains is the California FAIR Plan, a last resort policy offering limited protection at punishing prices. Even homes built to withstand natural disasters are not spared. In Big Sur and Carmel Highlands, homeowners who invested in fire-resistant materials and elevated foundations are still labeled high risk based solely on zip code. The system does not reward preparation. It punishes geography. Families who have lived here for generations are being priced out, while new buyers hesitate to take their place. The crisis is rippling through the local economy. Builders have slowed new construction because buyers cannot find affordable insurance. Listings linger, and even luxury markets in Pebble Beach and Pacific Grove are seeing fewer offers as ownership costs soar. Meanwhile, farm workers and middle-class families in Salinas and Marina are hit hardest, as premiums now rival rent, taxes, and daily living costs. Monterey County's story is no longer just about risk. It is about how the price of living in paradise has become too high for many to bear.
Number 6. Santa Cruz.
Santa Cruz was once the embodiment of coastal freedom. Surfers at sunrise, redwoods at dusk, a place where the Pacific met peace of mind. But by 2025, the price of that peace has become staggering. Homeowners now face some of the highest insurance premiums in coastal California, averaging over $10,000 per year. The reasons are layered. Coastal erosion threatens properties perched on fragile cliffs, while wildfire danger creeps down from the Santa Cruz Mountains each summer. And deep beneath it all, the region's earthquake exposure keeps insurers uneasy. What was once a haven of serenity has become a laboratory for the economic cost of climate risk. Neighborhoods like Bonnie Doon, Felton, and Scotts Valley have seen premiums double in just 2 years. Even homes built with metal roofs, cleared vegetation, and fire-resistant siding are being labeled high risk. Insurers cite regional volatility, not individual preparation, when setting rates. Some companies have pulled out entirely, forcing homeowners onto the state-managed FAIR plan, a safety net that covers less and costs more. Longtime residents who once paid modest premiums are now being forced to sell, refinance, or risk living uninsured. For first-time buyers, affordability has vanished. Monthly insurance costs can now exceed property taxes and in some cases rival a second mortgage. Deals fall apart when lenders require coverage that simply no longer exists. Local officials and state regulators are calling for reform, but change moves slower than disaster risk. Meanwhile, communities are bracing for another fire season, another storm, another round of cancellations. Confidence in the system is eroding faster than the coastline itself. Santa Cruz still glows. Boardwalk lights shimmer over Monterey Bay, the surf still roars beneath the cliffs, and downtown hums with life and art. But beneath that postcard beauty lies growing unease. People no longer ask if they can afford a home, they ask if they can afford to keep it safe.
Number 5. Oakland. Oakland's skyline rises proudly across the bay, a symbol of resilience, culture, and reinvention. But in 2025, homeowners here face a new and unexpected battle, surviving the insurance squeeze now gripping urban California. This time, it is not wildfire smoke drifting over the hills, it is something broader and more complex. Earthquake exposure, aging infrastructure, theft and vandalism claims, and a surge in water damage from aging pipes have combined to push premiums to record highs. Base rates have climbed across the city, with East Oakland, Rockridge, and the Hills seeing the steepest jumps. Typical homeowners now pay between $7,000 and $9,000 annually for basic coverage, and that does not include earthquake insurance. Most lenders require that separately, adding another $3,000 to $5,000 a year. For working families, those combined costs can rival an entire mortgage payment, turning stability into a luxury few can sustain. The consequences ripple through every block. Some longtime owners are walking away from older properties they can no longer afford to maintain. Others are rolling the dice, living uninsured in a city where one broken pipe or minor quake could wipe out years of savings. Developers are delaying projects, lenders are tightening requirements, and new buyers are growing wary of crossing the bridge from San Francisco. Insurers point to high claim volumes and underfunded city infrastructure. Residents blame policy failures and years of deferred maintenance. Either way, the result is the same: rising premiums, declining confidence, and deepening inequality between those who can absorb the cost and those who cannot. Yet through it all, Oakland's soul endures. The murals still blaze with color, the markets still buzz with music and life. But beneath that vibrancy runs quiet frustration. Homeowners asking how long they can keep up in a city that once promised opportunity but now demands endurance. If you want to see where California's affordability crisis collides with its insurance meltdown, subscribe to Discover the Nation, because Oakland's story proves that the next housing emergency is not about buying a home, it's about keeping one.
Number 4. Palm Springs. Palm Springs has always been more than a city. It is a mirage made real, where the desert blooms with wealth, art, and mid-century modern beauty. For decades, it stood as a retreat for those seeking escape from the chaos of Los Angeles. But in 2025, the dream of desert serenity has become a struggle for survival. Insurance costs, once an afterthought, are now reshaping life in this sun-soaked paradise. The numbers are staggering. Homeowners across Palm Springs and the Coachella Valley are paying an average of $11,000 a year for insurance. In neighborhoods near the mountains, where wildfire and flood risk overlap, rates soar past $15,000. Even homes with advanced fire suppression systems and steel roofing are being flagged as high-risk zones. Some insurers have stopped offering new policies entirely, while others demand premiums so steep they effectively shut buyers out of the market. The crisis has created a ripple effect throughout the region. Real estate deals are collapsing, short-term rental owners are exiting the market, and mortgage lenders are requiring proof of binding policies before approving loans. Builders who once filled the desert with sleek new villas are slowing down or canceling projects altogether. The irony is painful. Palm Springs was built as a haven of calm and luxury, a place where time slowed down. But now, homeowners are running financial calculations every year, deciding whether to renew coverage or take the risk of going uninsured. Those who choose to drop policies entirely are gambling with their life savings in one of the most climate-exposed regions in the state. Still, Palm Springs retains its magnetism. The palms still sway, the pools still shimmer, and the desert sky still burns with gold at sunset. But beneath that perfection lies unease. The city that once promised endless sunshine now comes with a growing financial shadow. Palm Springs is no longer just a resort destination. It is a glimpse into the future of luxury living under economic strain.
Number 3. Los Angeles. Los Angeles has always represented limitless possibility. The city where ambition meets sunlight and dreams are built from concrete and coastline. But in 2025, even this city of stars is confronting a harsh new reality. The insurance crisis has arrived, and it touches every corner of LA, from the canyons to the coast. In Topanga Canyon, wildfire proximity has driven premiums to record highs. In Echo Park and Silver Lake, hillside erosion risks are pushing rates further upward. And across South Central in Koreatown, earthquake exposure and aging infrastructure add even more financial strain. The average homeowner's policy in Los Angeles now approaches $10,000 per year, while many zip codes surpass $14,000. Add earthquake riders, liability coverage, and short-term rental insurance, and some residents are paying the equivalent of a second mortgage just to stay protected. Even luxury enclaves like Brentwood, Beverly Hills, and Pacific Palisades are not immune. Insurers are retreating from entire districts, labeling them as high-concentration zones. Renewal letters once met with relief now arrive with anxiety. Some carriers have stopped writing new business altogether, leaving homeowners scrambling for state-managed coverage under California's FAIR Plan, a plan with high costs and limited protection. The ripple effects are reshaping the city's housing market. Buyers are hesitating. Sellers are delaying. Developers are canceling projects as lenders refuse to close loans without proof of coverage. Transactions are falling through, and uncertainty is freezing momentum in one of America's most expensive markets. Yet, Los Angeles still glows. The skyline shimmers at dusk, the beaches hum with life, and the promise of reinvention remains as strong as ever. But beneath that brilliance lies fragility. A city learning that even endless sunshine cannot shield it from economic storms. To follow how insurance, climate, and cost are rewriting America's housing landscape, subscribe to Discover the Nation. Because in Los Angeles, even the brightest skyline can tremble when the economics of risk begin to shift.
Number 2. Malibu. Malibu has always been the symbol of California perfection. Waves that shimmer like glass, golden sunsets melting into the Pacific, and homes that seem to touch the sky. But in 2025, even paradise is paying the price of risk. After years of devastating wildfires, from Woolsey to Topanga Canyon, Malibu's insurance market is collapsing under its own volatility. Most private carriers have pulled out completely. Those that remain charge between $18,000 and $25,000 a year for basic coverage, and even then, approval is uncertain. Many luxury listings now include a chilling disclaimer. Buyer must verify insurability. That single sentence is enough to stall million-dollar deals. The impact is visible from the cliffs to the coastline. Along Pacific Coast Highway, oceanfront estates once snapped up in bidding wars are sitting unsold for months. Wealthy homeowners who once viewed Malibu as untouchable are now questioning whether the view is worth the risk. For every buyer who stays, 2 quietly walk away. Even rebuilt homes offer no guarantee of relief. Properties fortified with fire-resistant materials, metal roofs, and underground utilities are still labeled high risk because of their geography. The models that insurers use do not see beauty, they see probability. To them, Malibu is not a dream, it is a liability. Meanwhile, smaller homeowners and retirees who settled inland in neighborhoods like Point Dume and Malibu Park are feeling the sharpest pain. Premiums have doubled in just 3 years. Some residents have dropped coverage altogether, accepting the risk of total loss because the alternative is unaffordable. Still, Malibu remains breathtaking. The waves crash with power, the air smells of salt and sage, and the sunsets still paint the horizon in gold. But beneath that beauty lies fragility, a paradise where serenity has become a privilege and protection a luxury few can afford.
Number 1. Sonoma. Sonoma has always been a symbol of California's quiet beauty. Endless vineyards, golden hills, and the relaxed rhythm of wine country living. For decades, this region embodied the good life, where families, winemakers, and retirees built their futures among the rolling valleys. But in 2025, that serenity has been shattered by a financial storm unlike any the county has faced before. The crisis is not fire this time. It is insurance. Wildfires once reshaped the landscape. Now, it is the insurance market that is leaving scars. Premiums across Sonoma County have surged beyond $10,000 a year on average, and for many residents, even that no longer guarantees coverage. Major insurers have scaled back or withdrawn entirely, citing rising fire risk and costly reinsurance rates. Families who rebuilt after the Tubbs and Kincaid fires now face the cruel reality of being priced out of their own homes by protection costs alone. Thousands have turned to California's FAIR Plan, the state's last resort coverage that offers limited protection at punishing rates. It excludes essential elements like liability and theft, forcing homeowners to purchase multiple supplemental policies that strain even the most careful budgets. For many middle-class families, retirees, and small vineyard owners, those combined costs exceed what they pay in property taxes and mortgage payments. The real estate market is faltering. Buyers are walking away once they see insurance quotes. Sellers are lowering prices, and some are leaving the region entirely. Even local banks are tightening lending requirements, demanding proof of full coverage before closing, something fewer people can now afford. The heartbreak is that Sonoma remains as breathtaking as ever. The vineyards still shimmer under the evening sun, the air still smells of lavender and oak, and the charm of small-town life still lingers in every corner. But beneath that beauty lies uncertainty. Homeownership here is no longer about location or luxury. It is about survival.
Across California, the threat to homeownership isn't just price or interest, it's the skyrocketing cost of insurance. And in many cities, that cost is becoming unbearable. Want to know which cities are next? Subscribe to Discover the Nation for weekly reports on the housing trends that matter. From insurance chaos to migration collapse, we cover it all. Because in 2025, the true cost of owning a home in California isn't the mortgage. It's what you'll pay to keep it standing.